AI bubble on equity markets? With the strong rise in equity markets this year, more and more people are concerned about the potential bubble in equity markets. Let's have a closer look. First, let's define a bubble. You don't have an equity market bubble because equity prices have been rising strongly. You see it here in the chart that's showing a broad equity index, global equity market index, the price increase over the last roughly 50 years. You see the strong upward trend, and the green dots are showing whenever you had a new all-time high in this equity index. And of course, with a long-term upward trend, you have usually a continuation of new all-time highs. This is not a risks issue per se. Equity markets can rise in price if also the underlying earnings of the companies are rising. What is important, of course, is the ratio of those two. So if equity prices are rising for several years much stronger than what the companies are earning in the background, then the market gets expensive. For the experts, that's the PE ratio, so the price-earnings ratio. How much have prices been rising compared to what the companies are earning in the background? And that's exactly what you see in the next chart. The upper line shows for the US equity market this price-earnings ratio. When the line is going up, then equity market is really getting expensive. Price is rising stronger than earnings. And when the line is going down, it's getting cheaper. You see very clearly here this period end of the 90s when you had the last equity market bubble in the US. Internet was the new thing. People were very enthusiastic about what the companies will then earn because of this internet rising, and in the end overdid it. What you also see, unfortunately, is recently also US equity market prices have been rising stronger, faster than what the companies are earning in the background. The P ratio has also gone up to a pretty high level in the recent period. The reasons are obvious. With artificial intelligence, expectations are very high that this will transform companies, that especially the large tech companies who are dominating so far this area will have a tremendous growth in earnings. The good thing is, company earnings have also risen dramatically. Tech earnings in the US recently were rising at a clip of roughly 20% per annum, which is really impressive. Prices, on the other hand, have risen even further. So what is essentially, obviously, for the future is that company earnings can even accelerate from this pace and show that these high expectations are reasonable. So the question, bubble or not, is not as clear-cut as you might expect. But there's a quite easy answer to this issue. Because as you see in our last slide, the US equity market and here the US tech segment is the only area in the global equity market where this artificial intelligence euphoria is priced and markets are expensive. You have here these bars, and they simply show this price-earnings ratio for various markets on the globe. And you see it here, there's only one area globally that is really expensive, also in comparison to historic averages, which is the US tech segment, because of this AI hope and expectations, which makes the US market therefore expensive because the rest of the US market is at average valuation levels, but it has a very high weighting of those large tech companies. And this again makes even the global benchmarks expensive because they usually have global equity market indices a very high, roughly 70% weighting of US equity market, and therefore again the US tech companies. So what do you do if you're unsure if this is justified? Well, the rest of the world equity markets is still open for you. You see here European equity market, for instance. Basically all the rest is not at high pricing levels. Here the price-earnings ratios, the valuation, are within normal historic benchmarks. And there are some parts of the equity market that are even cheap compared to historical averages, which is, for instance, Central Europe, including Austria, which is China, and so on. So what's the consequence? Well, it's okay if you're unsure whether artificial intelligence and US tech is the only place to be or if it's a bubble. Difficult to answer at this point, but if you are unsure, you can make life much easier by simply investing much broader on global equity markets. As you saw in the previous chart, there are plenty of equity markets around, actually all of them except of US tech, that are not expensive by historical standards, that don't have these expectations priced for artificial intelligence earnings growth, and that many of them also show good prospect for good company earnings development over the near future. So make sure you don't miss our next issue where we'll give a short outlook on 26 capital market developments. Make sure to ring the bell, like the video, and see you again next time. All the best.